All right, so now what we're going to do here, continuing this debits and credits journey. I know it's a long one. You should see how long this is in a regular classroom setting. Ooh. All right, anyways, so what we're doing now is we're going to take the same transactions and we're going to transfer them to that T account, which again, that's a learning tool, but it's useful, but the problem is it's not how you're going to do day-to-day accounting. So now we're going to finally get to the actual accounting, how we're going to account for transactions in financial accounting from here on out. So this is the general journal format that we're going to put them in. And you'll note, again, I put dates for everything in this example where no dates were provided in the original. So it's just, I just made up some dates just so that to bring up the realism there. I didn't present them in the original because it didn't matter there, but now it does because you have to date everything here. So let's go over the basic architecture of your general journal. All right, so first you have a column for date, and that's the date that the transaction transpired when it took place. That's the only date we're interested in. We're not interested in the date in which you got around to booking it, right? Which is less of a problem now, but once upon a time, there's a lot of lag between booking transactions, excuse me, and when they actually, took place. So that was maybe more of a point of contention than it is now. Things happen a little bit more, quote unquote, real time than they used to. Then you have a column here for account description. Now that's going to be an account from your chart of accounts that you're going to derive this. So in most of your homework examples, they tend to give you a chart of accounts as like a drop-down menu. I believe that's the way that they usually structure it, and of course that's the way it's going to be structured in any business environment. You're probably not going to be in a position to decide which accounts you want to use, right? It's just going to be I can make up an account on the fly. If you're an administrator of the system, yeah, but if you're just somebody who's entering data, no, we're not going to give you that ability right there. Right, so that's just, again, comes from whatever your chart of accounts has to provide. Post-reference column, we'll get to what that's about momentarily. And then, of course, you have to have your one debit and your minimum one credit, again, DR and CR as our abbreviation. All right, so again, same 10 transactions taking on a different form. That's what this is. It's a gradual, transmogrification, which of course is how you would usually say of a lycanthrope or somebody who can change into a werewolf, but I'm using it here anyways. So we're moving from that accounting equation format, which is not really very friendly, and eventually we went to T accounts, and then now here we are finally at where we actually need to be when we're talking about doing accounting. Right, so again, same transactions, just taking on a new shape. So what we have here is, again, the initial transaction was what? It was the 50,000 shares issued by the corporation in exchange for $1 million. So the way we want to represent that in this format is a cash debit of $1 million. Now you'll notice there's a little indentation here for the second half of this, and that's just an old form. You're actually not going to see this necessarily used in a business environment. It's just I keep all the transactions that I show you in this form because it's more readable. That's why we do that. You indent slightly to the right because that makes it more readable. And you'll also notice the order in which we do the debits and credits is not accidental, right? We do debits first and then credits second because why are we doing that? Because we read from left to right. We read in that direction. So that's why we want to do the transactions in that same form. Start with the left, in this case the debit side. I guess I said left and right again after I said I wouldn't say it anymore. Damn. All right, anyways, so and then we go with the part that deals with the right, which is the credit half of that. So that's the normal form. I would encourage everyone to please get in the habit of booking everything in that form of debits first. That could be more than one, because you'll see as we get into compound entries, which is just an entry that has more than just one debit and one credit. I want you to do all the debits first, then do the credits after that. Remember, the rule is they all have to just equal each other. That's a total debits equal total credits. You're good to go. Does not mean there's just simply one of each, but that's the bare minimum that you have to abide. All right, so that's how this first transaction looked. Now remember, transaction number 2, so I'll just get that out of the way because it's a bit of a distraction. Actually, to me, maybe not you. All right, so we got the purchase of the 10 trucks for $250,000. So we want to demonstrate that by doing what? Debiting trucks. So there's our debit to trucks. And then, of course, crediting cash because we surrendered an equal amount of cash to purchase them. The third transaction was the purchase of supplies on account. So the business has more supplies, debit supplies to reflect that, but they also owe more as a consequence of that. So they owe $3,500. Transaction 4 was our providing services for a customer, $50,000 on account. So we want to reflect that because it's on account, that's accounts receivable. They owe us $50,000, and of course, because we provided the service, that means we've earned it. That's the timing mechanism for that. A little sidebar here. And I know this is my example. I'm the creator of all this stuff that you're looking at. So of course, it's easy to say, well, I'm just remembering what the transactions are, right? Just because I'm the one that did it. I came up with it. That's true to an extent, but it's also not 100% true, because what I'm really doing here is I'm looking at these transactions and I'm reading them, right? I'm untangling the code. Like, let's go to the next one. So I see cash as being debited, fees are credited. Again, if I hadn't created this, I would look at it and go, okay, I see $15,000. So that means they must have provided services for a customer for cash, $15,000. Because why? That's what this is telling me. Those two components, that's what I would reconstruct. That's a verbal reconstruction of this, shorthand. Again, that's why we call this the language of business, because this shorthand here is how we demonstrate transactions, and that's of course ultimately what you should be able to do. So that's the two prongs of how you tackle this material. The first prong is you're going to be given, okay, here's a transaction. They give you a verbal description, and then they say, now give me what that is. Like, put the transactions in general journal format like we're seeing here. But the other half of that is to be able to look at a transaction already in general journal format and then say, now give me a verbal description of that. Now that's normally something that I would do as part of an in-class problem, but you should still do that on your own. You should, quiz yourself, put some transactions in general journal format, like just look through your book or through your homework, just anything in that format, and then just say, okay, now can you verbally reconstruct that transaction? And I'll give you a little bit of advice about the best way to do that, and that is start with a verb. Like, if this was a creative writing class instead of an accounting class, I'd say start with a verb form, because why? Because it's action, right? You want to start with that because it kind of gets everything going. And also, you'll note it also will create a much briefer description, because a lot of times you don't need a lot of words to describe something. Like here, the one we were just covering, the cash, debit, fees, and credit. Again, a good straightforward verbal description is there, that you did what? Provided services for a customer, $15,000. Or you could even just say provided services. I could really trim it back to that, comma, $15,000. Why? Because we know for providing services, who are we providing them for? We're providing them for customers. That's implied in what you're doing, right? So you don't even have to say for a customer, because who else would you be providing a service for? That's just, in that context, I can, again, trim it down to three elements. Provided services, comma, $15,000, and that would be a completely legitimate description of that transaction. Of course, again, realistically, it's better to say exactly who is the customer to provide the services for, not just sort of ethereally some customer somewhere. So again, that's of course what you're missing when you look at this format, is it doesn't give you the whole story. It just says, here's the basic idea of what we did. So if you're reconstructing it, you're not going to have all the details, which is okay. But if you can come up with at least a generic way of describing it, then you're on top of the material 100%. So again, that's another aspect of something you have to tackle on your own. All right, so continuing. Right, so for the transaction 6, again, we provided, in this case, strike that. We had repairs to the trucks in the amount of $5,000. So that necessitated reflecting that we've incurred an expense, because why? We've used goods and services, so we used a service, in this case $5,000, so we want to debit repairs expense, and of course the offset was to credit cash for the same amount. Transaction number 7 was MST3K is going to pay off that amount that they owed for the supplies, so they're going to pay their creditor. In that case, you can just say paid creditor. Saying paid creditor on account is redundant in a way, because if it's a creditor that you're paying, we'll usually assume that means you already had done what? Booked an accounts payable, right? Because somebody that you're just, if you're just paying for something at the forefront like we did here, there's no creditor situation because the cash was already relinquished at the point, in this case, of the service. So if you say paid creditor $3,500, I would consider that a legitimate description of this one, because I would say, oh, well, that means that we did what? We must have, debited accounts payable and credited cash. Again, that's the way you test it, is if you give me that verbal description and I would book that transaction in general journal format like so, and those are equal to each other, then you described it adequately. Our transaction 8, this was our customer that owed us $50,000 paying the amount they owed us. So you can just verbally describe that one as received cash on account $50,000. That would describe it perfectly, because that on account tells you that it was from a customer who you had previously already recorded the revenue, but now they're just making good on the promise that they owed, meaning the accounts receivable. So that would entail the cash debit you see here and a credit to AR of $50,000. The 9th transaction was paying $25,000 in dividends to our owner, Mike Nelson. So dividends was debited, cash credited for the $25,000. And then lastly, recognition of supplies used during the period of $2,500. Supplies expense debit, supplies credit of $2,500. And so those are our 10 transactions, again, just taking on a new form. And this is the form from now on that we'll be working with. All right, so I'm going to get rid of some of this business here so that we can talk about the next topic of interest, which is there, the general ledger. All right, so what you're looking at when you look at the general journal is you're looking at, like, that's if you want to look at a specific transaction or a group of transactions and you just want to see what's going on there, you look in the general journal. But if you want to look at what happened to the accounts that are impacted by those transactions, you got to look in the ledger. So in other words, the way to look at this is this is basically, I call it it's the chart of accounts, actual living numbers. So it's your chart of accounts brought to life is what you're looking at there. Now, I didn't attempt in my handouts or in this video to give you all of the accounts in this form. Now, the way you could see the general ledger, it can be in either a 4-column or 3-column form. And I think your book is still using T accounts as a ledger, which again, not recommended in practice. So this is the form you're going to typically see is like this. I just gave you the cash account in this video. I gave you some other accounts in the other just as a sample. But again, I don't use them in the description here at all. We're just going to investigate, like, how did you get these balances in the cash account? So this is what you would see in the ledger. You'd see the name of the account, its corresponding number from the chart of accounts. That's why that's a very important idea, because it's a quick reference. Like if you want to query the ledger and there might be 1,000 accounts in there, wouldn't it be nice to say, oh, I know exactly what account I'm going for? Yeah, I'm just looking for account 101, put 101 in, takes you there. Right? So there's a lot of advantages to being able to assign numbers to an account specifically, so it just makes the query much quicker. Right, so this is the process. Now, in practical terms, like now, how fast is it to post from the general journal to the ledger accounts in question here? And the answer is it's pretty much instantaneous in the computerized environment. This is how it would work in that environment. It would be like so. So you want to post this transaction here, so you book it, and then usually there's a drop-down menu. You could say like post transaction, and you click that, post it, and of course usually there's a subquery like, are you sure you want to post this? It gives you one final check. Yeah, I want to post it. It's good. Boom, you hit that, and then poof, everything happens, right? And then all those numbers are now magically transported to the ledger accounts. What I'm going to do is slow down the process to show you exactly what happened in the moment you pressed that magical button there, and what just took place. All right, so what I'm going to do here is we're just going to focus on cash. That's it, and just a little bit more cleanup work here, just so that there's nothing else, no other potential eye magnets to worry about. Okay, so we're just going to focus on this one right here. So we had this cash debit of $1 million. So, okay, so we're going to hit the post button. So what's going to happen? All right, so we're going to go here, and what's going to happen is this. The date of that transaction is going to be transferred to the cash account. That's one thing. And you'll notice the the format of this is very similar to the general journal. Right? A date column. Now you'll notice usually if there's an account description, nothing ever goes in here except maybe the word balance. It's just sort of, so that the formats are similar. So in effect, if you got rid of that in a computerized environment, it probably wouldn't matter. But I just keep it in there because that's how I learned it. You will see another post-reference column here. Now you'll notice the purpose of this one is saying what page of the general journal did we get that from, or virtual page, right? So you'll have to have some way of freezing in place like what you mean by a page. Like you might define in the system like every 25 transactions equals one page. So why? So that we can say, well, where did that come from? It came from page 1 of the general journal. So that's all that's telling you there. Now you'll have two sets of columns here. So this is the four-column format I was describing. 4 columns, in other words, 2 debits and 2 debit credit columns. So you have 2 sets of those. So this first set of columns is immediately, what did this transaction do, right? What's its impact on cash? Debit or credit, increase, decrease. Over here is the balance in this account, right? So 4 column means you could have theoretically a negative balance, because that would be the only way you'd ever see a credit balance in cash, as if it was a negative balance. That's why some systems do away with, for example, if they would just have three columns, so you just see debit, credit, like we see here. That would still be there, but they would only have this one single column that says balance, and the implication would be that it's a debit balance. Now, again, that works for pretty much every account. The only thing that it would get a little tricky is if, let's say, because again, this is possible, this is one of the huge exceptions. You really are never going to see a deficit in an account unless we're talking about retained earnings. Retained earnings can have a negative balance. So if you ended up with a debit balance instead of a credit balance and retained earnings, that in this 3-column format would be shown as in brackets. So if you see a 3-column format, retained earnings, a number in brackets, that means that they're running a deficit, which is possible. For companies that are just startups, all they do is spend money, nothing comes in, they're all expense, no revenue. That's another way of looking at it. So in that case, you can expect to see a debit balance there. You're going to lose money at the outset, that's just the way it goes. So they would have to put that in brackets under this format. Otherwise, with a 4-column format, you would see the balance shift from the credit side to the debit side to take care of that. All right, so we have $1,000 we put in the cash account, and of course that equals a balance of $1,000. I'm going to go to the transaction on the next day, so where we had the credit to cash, just to show you the full impact of that balance column. So now we're crediting cash for $250,000. So we show that transaction, and again, it was on, oops. Yeah, okay, they're both on the first. They're from one, I thought I had it on different days. So we have date of the transaction, page it came from, there's the amount, and of course now that means cash is a $750,000 balance. So that's the purpose of this ledger. It's up to date, right? You know exactly what's in the account, up to date. So that's a big advantage right there. Now, what's the secondary thing that just happened there? Okay, so we have this amount, $1 million, or the 250 being posted in here, and then what account did we just post to? We posted to account 101, so that I'm going to draw an arrow. It's going to start here. Going to go to the next slide. Oops, going to go flying over this one. Oh, it's kind of irregular here. Kind of a bumblebee flight path going on there. And then it says, hey, what account did you post that to? Oh, we posted that to account 101. And of course, again, I could also have said, well, again, where did we post this from? Again, that's the other arrow. So this arrow is going the other way. Oop, try not to intersect there. So that's kind of what I did here. Oh, I just crossed the streams. If you get that reference, you're old. Anyways, so there's where that came from. So now what are we doing here? We're creating a two-way documentation flow. Right, so we're creating a two-way documentation flow so that you can do what? This is like a little bit of an audit technique where you would go from a source document, right? So you start with a source document, which I'll just put S, and then you say okay. So every source document should be what? Should be in the journal, which I'll put as a J, and then that should travel to the what? The ledger, which is a L, and then of course that will show itself. Keep the arrows in. Where? On the financial statements, right? And again, the connective tissue here is happening at this point right here between the journal and the ledger. In other words, we see account 101, so we know that means it should be in account 101 in the ledger, and then of course that amount should be factored in somewhere in the financial statements. We can also go the other direction. We can go, well, what's in the ledger, take an amount on the financial statements, investigate it like the cash balance, look in the ledger, okay, so we're in account 101, and then guess what we can do? We can look at all of these post references we have here and see, do they show up in the journal? Okay, yes they do. Oh, and guess what? Everything in the journal has a corresponding source document, right? Because that's the fact there, right? We should be able to do both ways, investigate numbers both ways, and without those post references, we can't do that. So that's the importance of why you need to have the account number in the journal and then the post reference, the page number in the ledger. You got to have that. Okay, now, so again, this whole process, because of the wonders of, everything being automated, is, again, greatly simplified. And one thing you don't have to have anymore, that, like one of the errors that's disappeared, is like a classification error where you get sort of a muddling of, like, let's say, like what we have here is cash debit for $1 million. Okay, so we got that there correctly. And then, of course, somebody, in theory, could have posted it to the wrong account, right? So this is like in the days of the manual system. So you might see, instead of 101 here, if you see something like 103, that means that they put, it's correct here. It's correct that it was a cash debit, but it ended up in account 103, which is the supplies account in this example. So somehow it ended up in the wrong account. So what you end up with is a hybrid classification error, where it's correct in the journal, but ends up in the wrong place in the ledger. That's not possible anymore. In a computerized environment, this name, cash, and this account number, they're linked. They're linked to one another, right? So because they're linked to one another, you don't have to worry about that hybrid classification. If you type in cash, 101 pops up. Type in 101, cash pops up. So that's one of the beauties of the computerized environment. All right, so we're done with how the general ledger and posting process works. So lastly, and this is the last thing in the debits and credits material, is the concept of a trial balance. Now, what are we doing here? We're checking the equality of debits and credits. That's it. So a little semantic. Name of the company. What are we doing? We're doing a trial balance. And again, if you look at the core knowledge handout, this is one of 3 possible trial balances you'll encounter. There's the initial trial balance before you've done any adjusting entries. Later videos will describe what all is going with that. And then you'll have the final trial balance. So you'll do an unadjusted trial balance. This is what we're looking at here. One after adjustment, adjusted trial balance. And then the last thing you'll ever do in the accounting cycle is a post-closing trial balance. So there is ways of distinguishing among those 3. Look at the core knowledge handout for that information there. And of course, this is going to take on the same basic concept as a balance sheet, meaning this is only true what our balances were at a point in time, right? So it doesn't tell us what the balances were before, day before, or day after, just at this point in time. This is just a listing of all of the accounts in the order they were presented in the chart of accounts, which also follows the other rules that we described, such as liquidity and whatnot. So that's all it's all implied in that. So this is, and I included accounts with zeros as well, just for completeness sake. So there's our cash balance. Again, we've seen that cash balance before. AR has been reduced to 0, supplies down to 1,000, 250 in trucks. Accounts payable was reduced to 0. Common stock was $1 million. Retained earnings has nothing in it right now because we're not recording anything directly in there. Dividends at 25,000. Fees are in 65. Repairs 5,000, 2,500 in supplies expense, and then nothing for miscellaneous. And again, this is all following normal balance rules. So again, if you're wondering why I'm putting them in the columns, I'm putting them in, see the normal balance rules. It all goes back to that. And that's why that's such a core concept. So we total debits and credits, and we get the same amount for each. So what did that tell us? That tells us that we've done everything mechanically correct. That's it. That means we follow the debits and credits rule. In fact, if you have a system that won't let you post anything out of balance, which is probably a good idea, like that, I'm always a big fan of that, but I still encounter students saying they work in an accounting system where you can post out of balance, and my immediate response is always, why? Why? Why would you do that? You're inviting human error. Let's introduce something we can completely, extract from the accounting system. Let's allow it to occur anyways. Is a bad idea. And if any of you out there are in the, computer science programming field, you're a programmer yourself, or you're becoming one, or thinking of becoming one, like, how many lines of code does it take to create a comparative analysis of, like total, the debits that were entered, and credits, and just logic check? Do they equal each other? Yes, you can post that. If not, error message, here it is, try again. 4 lines of code, maybe, something like 5 lines, I don't know. It's been a long time since I had a computer coding class, and that one was Fortran. Yeah, I'm old. Anyways, so that shouldn't even happen. That you can, post out of, debits and credits out, so that they are an equal. But still, because it's a possibility that you may encounter, we put it out there. But again, it just tells you, did everything mechanically correct. So what I list here at the bottom is the limitations, which are, again, it only checks debits and credits, because you can still do the following types of errors, and these will not be detected by a trial balance. Errors of omission, which just simply means missing transactions. Should have been booked. There's a source document, some sort of memoranda at the very least. It says we should book this, didn't book it. Errors of commission, duplicate transactions. Now this happens usually when people go on vacation. Somebody is not there to do their designated job. Somebody picks up their duties in the interval, and whoops, you get duplicate transactions. And there are ways of avoiding that, actually, if you have a good accounting system as well. And then this one, classification errors. Again, journalized and posted to the wrong account or accounts. All of these would go undetected by a trial balance. It just doesn't have the ability to detect them. It's just simply not in its capabilities. In other words, you like to go back, classification error. So let's say here, like here's the correct transaction right here. So again, so it's cash debit, common stock credit. So what if instead somebody booked this to, it ends up in retained earnings instead, which of course would also be a different account. It'd be account 302. So now we end up having $1 million credited in retained earnings instead of common stock. That's a classification error. But again, would that throw debits and credits out of balance? And let me demonstrate it for you right here. And the answer is no, because guess what happened? That $1 million wouldn't be here. It would now be here. I'll just sort of scribble that out so you get the idea. So that now the $1 million is there in cuneiform or something. So guess what? You would still have $1,065,000 of debits and credits. So it's in the wrong place. The debits and credits is unaffected, completely unaffected. So again, that's its big limitation. Can only make sure that your debits and credits are equal. Doesn't cover any of those other errors. And also doesn't cover the situation where maybe you just put an errant amount in, as long as it equals. Like instead of $1 million to common stock, it was entered as $100,000 to common stock, and cash is $100,000. Same thing. Of course, you would have probably picked up there was an error, because right here, when you went to purchase $250,000 worth of trucks for cash, and it says only $100,000. Oh, wait a minute. It should have been $1 million, so you would detect the error immediately there. So sometimes those types of errors can come to your attention because of circumstances like I described right there, but not always. Sometimes they fly right by. Nobody's any the wiser, and then maybe you see it in the trial balance and that we had a classification error. But again, it's not going to tell you that. You'd have to investigate each line of the trial balance to see anything look peculiar. Otherwise, if you just relied on this information here, it's not going to tell you that you committed an error of omission, commission, or classification error. All right, and that concludes the debits and credits material. And again, the next area of interest is going to be delving into the adjusting entries and all the fun that entails. So see you then.